Test 1, 2, 3. So I'll go ahead and call this meeting of the Credit Risk and Mitigation Committee together. And for the purposes so that we can go ahead and go with the presentations. I know the actual members of the committee are in transit and will come in as necessary. So let's go ahead and start with the roll, if we could.
Sure. So this meeting is being conducted as a virtual meeting and in person. So I will do a roll call of the trustees to confirm attendance. Mr. Rue, Mr. Gatto, Mr. Fay, Mr. Green, Trustee Jones,
Here.
Miss Me, Miss Martin, and Miss Ginsburg.
Here.
Okay. Staff participating in the meeting include the following: CIO John Grable, Deputy CIO Jude Perez, Chief Counsel Stephen Wright. Investment staff include Bache Masarajian and Chad Timko. Trustees, please use your raise your hand option to be placed in this queue. At this time, we ask all meeting participants to mute their mic until you're ready to speak. And now we may proceed with the agenda.
So
yes, and trustees, good morning. Just to note for the record, we don't have a quorum, so no action can be taken, but the presentation can proceed for the information of those here.
Okay, and then once the members arrive, they can go ahead and approve the minutes.
Yes, at that point.
Okay, all right, thank you. All right, Bache, if you'd like to kick it off, that'd be great.
All right, let me just wait for the slides to load. I think I have control. All right.
Okay, thank you.
Good morning, Mr. Chair, committee members, and trustees. We have one presentation on today's committee agenda, and that's a review of performance for the risk reduction and mitigation functional asset category. Because we have new committee members and new trustees, we thought it would be helpful to begin with an overview of the risk mitigation category, followed by a review of the economic environment, its impact on yields, and on the performance of the broad investment-grade bond market. After that, we'll do a deeper dive into the role, allocation structure, and performance of risk mitigation's 4 components. I'll cover the bond and cash sections, and Chad will present the hedge fund section. Please note that we've included an appendix with additional performance details, a manager scorecard, a table with bond index characteristics, and a glossary. As the name risk mitigation indicates, the purpose of this category is to reduce the risk of the overall fund. As the graph in the upper left indicates, risk mitigation has the lowest risk and lowest expected return among LACERA's functional categories. In this chart, we're measuring risk by the standard deviation of returns. But risk mitigation reduces the fund's risk by other measures as well. For example, providing liquidity, by diversifying the portfolio, and by providing downside protection. We'll have more to say in each of the individual sections, but for now, I'll highlight that the primary role of cash is to provide liquidity, to pay benefits, and to rebalance. And the primary role of investment-grade bonds is to provide steady income with low standard deviation. Long Treasury bonds are in this category not because they themselves have low risk, but because historically their negative correlation to stocks has diversified the total fund and thereby reduced the fund's risk. Unfortunately, long-term Treasury bonds didn't provide that diversification in 2022, and I'll come back to this point in a bit. The 4th component is hedge funds. You might be asking yourself, why are hedge funds in a category called risk mitigation? Aren't hedge funds risky? Well, some are and some aren't. The term hedge funds is very broad, and it encompasses diverse strategies that invest across all asset classes. Chad will have more to say on this point, but for now, I'll say that LACERA's implementation of hedge funds is designed to reduce the total fund's risk by focusing on strategies that have low to moderate volatility, have essentially zero correlation to stocks and bonds, and perform well when stocks decline. This page shows the allocation targets for the risk mitigation category. The colorful slices of the pie chart show that together they comprise 19% of the fund's target allocation. However, you might recall that from last month's total fund performance report, that although the category represents 19% of the dollars invested, it represents only 3% of the total fund's risk. This provides clear evidence of the category's risk mitigation qualities. Now, before we dive into how each component performed last year, let's set the stage by reviewing the economic backdrop. On this page, we have graphs that show three key measures of the health of the US economy: inflation in the upper left, unemployment in the upper right, GDP growth in the lower left, and the graph in the lower right is the upper end of the range for the Fed funds target. As you know, the Fed's role is to stabilize the economy in response to economic and financial disturbances. And of course, the most consequential disturbance of this decade has been the COVID outbreak and its aftermath. As you can see in the upper right chart, right here, unemployment the rate jumped to nearly 14.8% in April of 2020, when over 20 million jobs were lost. Similarly, the chart in the lower left shows that GDP growth declined at a 7.5% annualized rate in the second quarter of that year. In response, the Fed cut the Fed funds rate to a range of 0 to 25 basis points. You can see that here. In March of 2020, and kept it there for almost 2 years in order to stimulate the economy. But the Fed was walking a monetary policy tightrope given the inverse relationship between unemployment and inflation. As the chart in the upper left shows, inflation started increasing soon thereafter, with headline CPI, you can see the spike right here, headline CPI exceeding 9%, and the Fed's preferred measure, core PCE inflation, personal consumption expenditures inflation, exceeding 5.5% by the middle of 2022. And of course, you probably saw earlier this morning, the latest CPI report wasn't that encouraging. It came in at, the headline rate was 3.5%, and the core rate was 3.8%. So the Fed has a little bit more work to do. But going back to 2022, by then the Fed had started raising rates, leading to 11 rate hikes between February of 2022 and July of 2023. You can see that here, lifting the upper end of the range to its current level of 5.5%. The rate hikes and inflation spike led to increases in longer-term interest rates, resulting in 2022 being the worst year on record for investment-grade bonds. Now, the key question in investors' minds is when and how rapidly will the Fed start cutting rates? Late last year, the consensus was that there would be about half a dozen rate cuts in 2024, but given the continued strength of the economy and the persistence of inflation above the Fed's 2% target, as we saw that confirmed earlier this morning, the expected number of rate cuts in 2024 is now down to maybe 3, maybe fewer. Keep in mind that the Fed funds rate represents the cost of borrowing money overnight. What about longer-term interest rates? For that, we turn to yields on US Treasury securities, which serve as a bellwether for all other bonds. It's not an exaggeration to say that all other investment-grade bonds are priced at a yield spread to comparable maturity US Treasuries. The chart on the left shows the US Treasury yield curve at 3 points in time. The green chart shows yields at the end of 2022. The dotted blue shows the yields at the end of the third quarter of 2023. And the red chart shows yields at the end of 2023. As a reminder, the yield curve shows the yield of bonds with different maturities. So moving along any one curve, you can see that the yields of short-term treasuries are higher than the yields of longer-term treasuries, something called an inverted yield curve, because that's not the normal pattern. Note that yields increased in the first 9 months of 2023, and then in the fourth quarter, they fell back to the levels at the beginning of the year. You can see that if you go from green to dotted blue, that's an increase, and you go from dotted blue to red, that's almost back to where they were at the beginning of the year. Now, Given the inverse relationship between bond yields and prices, bonds performed poorly in the first 3 quarters, but rallied in the fourth quarter, as shown in the table to the right. You can see here, let's focus on the 30-year in the last column at this table. In the first 3 quarters, the 30-year constant maturity treasury was down almost 10%, minus 968. But in the fourth quarter, it rebounded, increasing 12.85% for the full year, up 1.93. Now also notice that for the full year, if we go across this row, the best performing sector of the U.S. Treasury yield curve was 3-month Treasury bills. T-bills were up over 5%, whereas you can see the 30-year was up less than 2%. Now, oops, wrong way. Now, let's see. This page shows a similar return breakdown for the Bloomberg U.S. Aggregate Bond Index, which is the most commonly used investment grade benchmark, and also LACERA's benchmark for investment grade bonds. The first column on the left shows a similar pattern right here for the U.S. Ag. Negative return in the first 3 quarters, followed by a positive return in the fourth quarter, resulting in a solid return of 5.53 for the full year. Now the pie chart on the right shows the composition of the aggregate index. As you can see, it's about 42% treasuries, 27% so in mortgage-backed securities, and about 5% in government-related issues. Putting those together, you have almost 3/4 of the index that has essentially no credit risk. The one part that does, the biggest part that has credit risk is the corporate sector, shown in green, representing 25% of the index. And you'll see in the table to the upper left here that corporate bonds were the best performer in 2023 with a return of 8.5%. Now this page lists the benchmarks for each of the 4 components right here. The point I want to highlight is the last column of the table. Note that the hedge fund benchmark is 3-month T-bills plus 2.5% with a 1-month lag. Our cash benchmark is the same T-bill index without the lag and without the spread. It's that spread of 2.5% that causes the hedge fund benchmark to be non-investable. And Chad will have more to say about this shortly. Now, we've already covered the material on this page, so let's move to the next one, which shows the structure and guidelines for the investment grade portion of risk reduction and mitigation. And by the way, our colleague Kwok will discuss the risk mitigation guidelines later this morning during the Board of Investment meeting. The table in the upper right shows the board's approved structure, a target mix of 70% passive, and by passive we mean an indexed approach, so it has very low active risk or tracking error, less than 15 basis points a year, combined with a 30% allocation to actively managed portfolios. I want to highlight that our 2 active managers, you see them here on the pie chart to the left, follow what's known as a core bond strategy, which means that they take very low active risk and they don't make investments in any sectors that are not included in the benchmark. This page shows the performance of the investment grade bond portion. The bar chart on the left shows that the composite outperformed the benchmark slightly, 5.8 versus 5.5 in the past year. Over the past 3 years, performance has matched the index, delivering on the objective of consistently delivering index-like risk and return. Note in the right half of the page that as of year end, the portfolio's duration was 6.4 years. Duration is a measure of sensitivity to interest rates, indicating that if interest rates increase 1%, prices would decline about 6.4%. But note that since bonds provide income, if that interest rate increase occurs over a period of a year, the total return would not be a loss of 6.4%, but more on the order of 3.4%, because over a period of a year, the investor would have received about 3% in income. Now keep this duration figure of roughly 6 in mind, because I'll come back to it in a bit when we're talking about long treasury bonds. Also note that the portfolio's average yield was about 4.5% at year end. Today, it's about 0.5% higher, just under 5%. Now we come to long-term treasury bonds. This is an allocation that was added at the previous strategic asset allocation 3 years ago. Its role was to be a hedge against the growth portfolio, given its expected negative correlation to stocks. Unfortunately, the correlation turned positive in 2022 as both asset classes generated negative returns. The only silver lining is that the allocation to long treasury bonds enabled us to have a higher allocation to growth than we would otherwise have had at the same level of risk. And stocks performed very well in 2021, 2023, and so far this year. Turning to portfolio structure, we see that the board selected a 100% indexed approach. We have one manager, BlackRock, and since this index consists of approximately 80 bonds with maturities between 10 and 30 years, our manager, BlackRock, is able to hold all the index constituents in a full replication approach since all the bonds are liquid. Turning to performance, we see that over the past 3 years, the portfolio has essentially matched the index. I will note that the 1-year return difference is a little bit misleading and is entirely attributable to the fact that our accounting books use a different pricing source than the index to value our holdings. These pricing differences cancel out over time, as reflected in the 3-year returns. Nevertheless, we're working to eliminate these short-term discrepancies by working with our custodian to use the same pricing source as the index provider. Note that the duration of this portfolio is 15.8, or roughly 2.5 times larger than the duration we saw earlier for the investment grade bond portfolio, which had a duration of 6.4. It's worth keeping this duration difference in mind later today when the Board of Investments deliberates on the fund's strategic asset allocation, because a 1% reduction in the long treasury allocation would be offset by a 2.5% increase in the allocation to the broad investment grade bond portfolio. Now I'm going to hand off to Chad, who will cover the goals, structure, and performance of the hedge fund portfolio, and then I'll return afterwards to conclude the presentation.
Thank you, Vache. Good morning, Mr. Chairman, members of the committee, members of the board. On page 18, this page provides an overview of the roles and objectives for LACERA's hedge funds program. The portfolio is designed to provide moderate returns while maintaining a low sensitivity to major markets. A low sensitivity to major markets means that we do not want common market risks, such as growth risk or interest rate risk, to be drivers of returns in LACERA's hedge funds portfolio. The return profile, as detailed in the honeycomb, is expected to be frequently positive and provide downside protection during market drawdowns, especially equity market drawdowns. The next page depicts LACERA's program in relation to other possible implementations for hedge funds programs. Tail hedging portfolios that are designed to profit in a market crisis but often lose value in the long run would plot in the lower left. LACERA's program is conservatively implemented where return expectations are positive with a low correlation to major markets and a low correlation to directional portfolios. We take a middle ground approach or an absolute return approach and focus heavily on risk metrics, not just a single return number. The takeaway here is that our program is designed to be risk mitigating with positive returns over time. Slide 20 reminds us about the portfolio structure here at LACERA. In recent years, we have successfully ramped up the hedge funds portfolio to its 6% strategic target allocation. The portfolio includes 8 direct managers and an emerging manager program that is managed by a separate account manager. Ongoing initiatives involve monitoring the portfolio, building a reserve manager pipeline, and ramping up the emerging manager program. It should be noted that portfolio structure is more diversified than may appear in the pie chart, with each manager employing several or more sub-strategies. The following two slides highlight results of the program in recent years. In the top left graphic, we can see that equity markets in black had material losses, also referred to as drawdowns, in both 2020 and calendar year 2022. Over the same time frame, LACERA's hedge funds portfolio in green exhibited significantly less downside volatility and effectively preserved LACERA capital. Now I'm going to discuss some key metrics that are shown in the lower left of the page. The first is beta. Beta is a ratio that measures sensitivity across two assets. It measures the degree to which the prices of two assets move in tandem. In this case, it measures how sensitive LACERA's hedge funds portfolio is to movements in the global equity market. So a 3-year trailing beta of 0.00, highlighted in orange in the lower left, demonstrates successful risk mitigation through the absence of sensitivity to equity markets. A primary role of LACERA's hedge funds program, as Vache mentioned, is to diversify away from growth risk or equities, which is a dominant risk elsewhere in LACERA's total fund. This is why an equity beta reading of 0.00 is particularly attractive. Another important metric is the up-down capture spread that is also highlighted in orange and is in the mid-20% range across time periods. The up-down capture spread considers both up capture and down capture, so let's define the component variables first. Up capture, which is shown at 7.6% over the 3-year period, indicates that when equities had gains, LACERA's hedge funds portfolio also gained 7.6% of the value gained by equities. And that's on average. Down capture, which is shown at negative 21% for the 3-year period, indicates that in months when equities experienced losses, LACERA's hedge funds portfolio gained an amount that was 21% of the equity loss. A negative number in downside capture means that on average, our hedge funds portfolio had a positive return when equities had a negative return. Putting these two components together, we see an up-down capture spread over 3 years of 28.6%. A reading above 1% is good, a reading above 20% is great. This statistic tells us that LACERA's hedge funds portfolio adds value through its combination of participating in positive equity markets and protecting capital or generating small gains when equities experience losses. For more detail about how our program performs when equities have losses, I'll flip to the next page. Thanks, Vache. On slide 22, the upper right diagram illustrates individual months where equities experience losses, and we can observe that typically in these months, LACERA's hedge funds portfolio, as shown by the blue bars, generated a gain. This is a graphical representation of negative downside capture that I just discussed and successful risk mitigation. We're pleased with these results as they indicate that the program is achieving its board-approved objectives and preserving LACERA capital when the preservation is most valued, that is negative equity markets. Relative to the benchmark and shown on the left side of the page, the portfolio has underperformed in the recent year and has outperformed over a 3-year time frame. As Vache mentioned, it is important to note that the benchmark of cash plus a spread of 2.5% is uninvestable, and comparisons to it in short time periods are less instructive. The recent short time frame includes an economic period when interest rates rose dramatically, and that materially benefited the benchmark. In other words, the uninvestable benchmark benefits from elevated rates much quicker and more directly than does LACERA's hedge funds portfolio. On slide 23, there's an overview of the Emerging Manager Program within hedge funds. The program launched 2 years ago and has invested in 8 newly created firms through the end of last year. Early performance metrics show that the program has underperformed the hedge funds benchmark, but the program has mitigated risk by delivering positive returns in a time when investment-grade bonds lost capital. As a reminder, manager graduations are a goal of the program, and we are optimistic that several of the underlying managers will compete as graduation candidates in the coming years. At this time, I'll hand the presentation back to Vache to touch on other sections.
Thank you, Chad. Turning to cash. Cash is the primary source of liquidity for the fund and is paramount to meeting LACERA's mission to produce, protect, and provide the promised benefits to our members. Cash is also the nexus for all portfolio rebalancing, as flows from one asset class to another are conveyed via cash. The bar chart in the middle shows that we typically keep about $1 billion on hand, equivalent to 3 months of benefit payments. The cash portfolio is in a separately managed account with guidelines customized to LACERA specifications to maintain very high liquidity and very low risk. The portfolio is managed by State Street Global Advisors, the investment management affiliate of our custodian bank, with prudent separation of duties while benefiting from close communication and collaboration. The top part of this page presents the returns of the entire risk reduction and mitigation category, reflecting the contributions of all 4 components. The bottom half of the page repeats performance charts we saw earlier in the individual sections. Note the negative absolute returns in the charts in the lower left and in the middle. This highlights what a challenging environment the last 3 years have been for investment-grade bonds and long-term treasuries. Fortunately, the hedge fund portfolio generated positive returns and over the past 3 years outperformed its benchmark, as shown in the lower right. We'll conclude on this page, which summarizes both risk and return for the entire category. As you can see, over the past 3 years, risk reduction and mitigation category has generated a higher return than its benchmark, while experiencing lower volatility as measured by standard deviation. In the graph, our portfolio, the light blue box, is to the north and west of the benchmark, which is shown as the dark blue diamond. Certainly, the negative absolute returns are disappointing, but we cannot control absolute returns, which are determined by the market. We'll just have to find consolation in our relative returns in outperforming the benchmark. But I'll end on a bright note, because the rise in yields has improved the outlook for bonds by lifting their expected return to its highest level in over 15 years, as you'll see during the strategic asset allocation discussion later today. So with that, we'll stand for questions.
Thank you for the presentation, and thank you, Trustee Jones, for starting the presentation. Any colleagues have any questions? No questions? Great. Thank you so very much. Vache, thank you for the presentation. It's outstanding.
Thank you.
So Linda, we have to go back.
So the first item that we missed was a procedure for teleconference meeting attendance under AB 2449. We don't have anybody participating under that procedure. The next item is going to be the approval of the minutes.
Could I get a motion to approve the minutes?
So moved.
Could I get a second? Second. Roll call vote, please.
Sure, 1 second. Trustee Green is absent. Trustee Fay?
Aye.
Trustee Gatto? Trustee Rue?
Yes.
And Trustee Jones?
Aye.
Okay, the motion passes unanimously.
Next, I believe we have public comment. Do we have any, Linda?
We don't have any public comment.
Okay, no public comment. Moving forward, we just did the reports, so, whoops, let me see this.
Items for staff review.
Items for staff review.
Nothing,
And if moving on to items for future agenda,
nothing.
good of the order. Anybody want to share for good of the order or move on, or wait, save it till the general meeting? Okay, then we are adjourned.
Yep.
Thank you so very much.